Silver investors. This is not a drill. We are hours away from a 9-day window where China goes dark. COMEX is short 4 times more silver than it can actually deliver, and Western banks get their last clean shot to crash the paper price before a delivery deadline that could expose the entire system. I'm OG John AG, and in this video I'm going to break down why China just built a fortress around 70% of the world's refined silver supply, how COMEX ended up with 400 million ounces of paper promises against 100 million ounces of registered metal, why January's 7 times normal deliveries were the start of a bank run on vaults, how the next 9 days could produce the ugliest red candles of this bull market, and why that smash, if it happens, is likely the greatest buying opportunity of your lifetime, with February 27th circled in red. Segment 1. Your money versus the printing press. Before charts, before COMEX, the Asian guy starts with your phone. He tells you, open your banking app and look at your balance. Now ask, is that number growing faster than governments are printing? If not, you're getting robbed in real time. Key point, when currencies rot, stock indices can go vertical, not because companies are winning, but because the measuring stick is dying. That's the backdrop for why silver and gold even matter in this story. With that in mind, he timestamps the situation. Saturday, February 14th, 2026. Less than 24 hours before China shuts down its markets for 9 consecutive days. During those 9 days, the gatekeeper of 60-70% of global refined silver goes silent. COMEX, short about 400 million ounces of paper silver with 100 million ounces registered, gets its best chance to force the price down before March delivery. Segment 2, China's fortress, 44 licenses and a broken market. First, the battlefield. China controls between 60% and 70% of the world's refined silver supply, not ore, finished bars. They import raw material from countries like Mexico and Peru, refine it, then decide where it goes. For decades, that refined silver flowed freely to Apple, Tesla, Western industry, and yes, into COMEX when banks needed real metal to back their paper games. Then on January 1st, 2026, Beijing flipped the switch, introduced a new export licensing system. Only 44 companies in all of China are now allowed to export refined silver. This is not a regulatory tweak, it's a chokehold. Effect, if you're a Chinese refiner, you can sell a bar to New York at $77 or to a domestic solar EV buyer at a time when China is installing 160 gigawatts of solar this year and churning out millions of EVs. You sell at home, the metal stops leaving the country. Result, the market fractures into 2 prices, a Western paper price in New York, a higher physical price in Shanghai. Reported gap, Chinese premium running $15-20 per ounce above Western prices, roughly a 25% spread. In normal markets, 1% arbitrage is huge. A 25% spread is a black hole, proof the metal is trapped and not flowing. Why is China doing this? Because they own the metal. They're installing $160 of solar, tens of millions of ounces of silver that never come back, building EVs, and stockpiling for their own industrial base. Restrict exports, let global price rise, accumulate at home. That's economic warfare and textbook capitalism at the same time. Segment 3. COMEX's fractional reserve silver, 400 melmers sold, $100 in stock. Now the other side of the battlefield. COMEX and the Western banking cartel. Numbers from the exchange's own data. Registered silver for sale, deliverable, about 100 million ounces. Open interest in March and other contracts. About 400 million ounces of silver obligations. So they've sold 4 ounces of paper silver for every ounce actually in the registered bucket. Total vault holdings including eligible, around 300 million ounces combined, but only that 100 million is actually tagged for delivery. Eligible belongs to clients who have not agreed to sell. Analogy, it's like selling your car to 4 different people and promising to deliver it next week. You assume not everyone will actually ask for the keys at the same time. This is fractional reserve silver, exactly like fractional reserve banking. Works until there's a bank run. What are we seeing now? The early stages of a run on physical. Segment 4. January, a 7x delivery, bank run. Historically, January is quiet for silver deliveries. Around 7 million ounces is normal. This January, about 50 million ounces were delivered, 7 times the usual volume. Interpretation. Contract holders are saying, keep your paper, give me bars. People are standing for delivery instead of rolling. That drains registered stocks and pushes COMEX toward the wall. More promises than metal. Fewer holders willing to play the paper game. At the same time, silver is in a multi-year structural deficit, and China has basically locked up the primary resupply line for refined metal. Segment 5. History lesson. Silver Rule 7 and the Hunts. To understand what Western banks do under pressure, the video rewinds to 1980. The Hunt brothers, Texas billionaires who began buying silver in the 1970s as inflation protection, just like modern stackers. They got aggressive, accumulated so much they effectively controlled half the world's tradable silver. Price went from $6 to $50 in months. The exchange directors, themselves short silver, panicked. On January 7, 1980, they implemented Silver Rule number 7. You could no longer buy silver futures on margin. Longs needed 100% cash. Shorts could still use leverage. They strangled buying power while leaving selling power intact. Price collapsed from $50 to $11 in weeks. Hunts couldn't meet margin calls, were liquidated, bankrupted, and later sued for manipulation. The banks and exchange, who had been short, walked away clean. Lesson: when the casino is losing, it changes the rules. 1980. Target SAS 2 oil billionaires. 2011. Target SAS retail coin buyers. 2026. Target SAS China. This is no longer David versus Goliath. This is Goliath versus Godzilla, and you, as a retail stacker, accidentally sit on Godzilla's side of the table. Segment 6. The 9-day window. China dark. Banks unleashed. Timing is everything. Key dates. Sunday, Feb 15, Chinese New Year begins. Shanghai Futures Exchange shuts down. Chinese financial markets go dark for 9 days. Monday, Feb 17, U.S. President's Day. U.S. markets closed. So you get a 2-day overlap where both China and U.S. are shut. Then from Tuesday 17th to Monday 23rd, COMEX is open while China is still dark. That's 9 days with the world's largest physical buyer offline. 9 days where the tug-of-war rope goes slack on one side. From the bank's perspective, they are bleeding inventory, short 400 million ounces with 100 million registered. March 1st notice day hits on February 27th, 13 days after the video's timestamp. Their objective in this window, scare as many March longs as possible into rolling their contracts or taking cash settlement instead of metal. Best way to do that, smash the paper price while China cannot respond with physical buying. Tactics the video lays out: flood the futures market with shorts, hike margins for longs to force liquidations, coordinate media messaging, silver rally over, illiquid, bubble, avoid. This is psychological warfare on top of financial warfare. Segment 7, China's counter, margin hikes on foreign shorts. China isn't naive. In the 72 hours before shutdown, reports say, Shanghai Futures Exchange has raised margin requirements specifically for short positions, especially foreign players, implemented restrictions aimed at Western hedge funds, banks, using Shanghai to suppress price while China is offline. They're building a fortress, not banning shorts entirely, that'd kill credibility, but making it very expensive for foreigners to stay short through the holiday. So if you're a Western hedge fund, either close shorts before the holiday or post huge collateral to keep them. Either outcome favors China. Shorts close, price stabilizes. Shorts stay, China collects margin and ties up their opponent's capital, but the fortress isn't airtight. Even if Shanghai is protected, COMEX can still play its usual game. Raise margins, add paper shorts, use US media as an amplifier. That's why this 9-day window is so dangerous and so important. Segment 8. The likely script. Smash now, suicide later. The Asian guy's base case. Banks try to crash paper silver between Feb 17 and Feb 23 while China is dark. Goal: drive price low enough that March contract holders say, forget delivery, just give me cash, or I'll roll to a later month. If they succeed, they kick the can to April, then May, then June, each time hoping supply somehow catches up or demand cools. But here's the flaw: China reopens on Feb 24. If Western banks have forced the price down artificially, China simply buys everything cheaper. Lower price, faster drain of remaining COMEX inventory and Western physical. The metaphor: banks are burning the furniture to heat the house. It works one more night, but the furniture doesn't grow back. Each smash increases the structural problem by accelerating physical outflows. This is why the video calls it a suicide strategy in the long term. Segment 9, February 27th, D-Day for Delivery Circle. This date, February 27th, 2026, first notice day for March silver. On that day, contract holders must declare, cash please, or give me metal. If a large percentage of that 400 ounce open interest stands for delivery, COMEX doesn't have the metal. They must convert eligible to registered, if owners agree, lease silver at high interest just to survive, negotiate like crazy to roll contracts or invoke force majeure, legalese for we cannot deliver what we promised. If they ever have to admit that publicly, the paper price loses credibility overnight. Pricing power shifts from New York to Shanghai, from futures to physical. The video is clear. It's not predicting COMEX will definitely break on Feb 27. But every month, vaults get lighter. China tightens exports. More people stand for delivery. We're watching a slow motion collapse of the paper system. Not one big bang, but a grinding drain until eventually the vaults hit critical and the charade can't continue. When that break finally comes, he argues, price won't rise 10-20%. It will gap to a new level reflecting true physical scarcity, the way nickel did. Segment 10, Nickel 2022, the blueprint. In March 2022, nickel showed you how a broken paper market behaves. Chinese producer Tsingshan was short about 200,000 tons of nickel on the LME. Russia invaded Ukraine, a major nickel supplier, and prices exploded. Tsingshan tried to cover, but there wasn't enough physical metal. Price went from $29,000 to over $100,000 per ton in under 48 hours. Margin call, about $12 billion. Tsingshan couldn't pay. The London Metal Exchange's response: halted trading, canceled all trades from the spike, rewound the clock to save the big short and shaft everyone who was right. Lessons: when paper markets break, exchanges change rules to protect insiders. Prices don't glide. They spike into a new reality if allowed to. Nickel is tiny compared to silver, and that squeeze was one company. Now imagine, a nation with $19 trillion in GDP and nuclear weapons on the other side of the trade. China versus COMEX, not one producer versus LME. Can COMEX simply cancel trades if China is the counterparty? That's a much more dangerous game. Segment 11, what you should expect and do in this window. The video ends with a clear message for stackers and serious investors. Expect in the next 9 days, US closed Monday, long weekend to plan. From Tuesday on, likely, hard selling in paper silver, red candles, headlines claiming the rally is over. Core advice: do not panic, do not sell physical. Recognize the smash as a tactic. Trapped shorts trying to shake you out before Feb 27. If you don't own silver yet and we're waiting for a pullback, this window might be your last chance to buy at current levels. Use the 3-day weekend to research dealers, plan orders, and prepare to buy the dip and take delivery if price is smashed artificially. What to watch? Registered inventory and COMEX vault data. If registered keeps falling during China's shutdown, that confirms physical demand is overwhelming supply despite any paper price crash. And finally, mark February 27th. High deliveries, pressure explodes. Low deliveries, banks buy time, but the structural direction doesn't change. Summed up in his words, China controls 70% of refined supply and has restricted exports. COMEX is short 400 Mount Oz with 100 Mount registered. China goes offline for 9 days. Banks get a window to attack paper. Feb 27 tells you how close we are to the end game. This is not the moment to be shaken out by red candles. It's the moment to understand the mechanics, hold your nerve, and if it fits your plan, use fear to your advantage instead of being used by it. You've been watching John AG here, and I'm OG John AG. If this helped you see why the next 9 days and February 27th matter more than any single price tick, hit like so this kind of battlefield breakdown doesn't get buried. Subscribe and turn on all notifications, because when the paper charade finally snaps and physical reality sets the price, you'll either be holding a stack or holding a story about how you watched it happen from the sidelines.